For decades, Americans were taught one simple belief. When the world gets dangerous, money runs into the United States. Wars. Capital flows to America. Recessions. Investors buy U.S. assets. Global instability. The dollar strengthens. That belief is so deeply ingrained that almost no one questions it anymore. But quietly, without press conferences, without headlines, something unprecedented just happened. BlackRock, the largest asset manager in human history, overseeing more money than the GDP of every country except two, began shifting to $0.1 trillion away from the United States. Not selling everything, not leaving America, but repositioning capital at a scale that signals a regime change. And here's the uncomfortable mystery. If the smartest capital on earth is diversifying away from America, what do they see that the public doesn't? This is not about politics. This is not about elections. And it is definitely not about short-term market cycles. This is about the architecture of the global financial system, a fault line that's finally cracking. Who BlackRock really is. To understand why this matters, you need to understand what BlackRock actually is. BlackRock is not a hedge fund, is not a bank, is not a government agency. It is something far more powerful. Founded in 1988 by Larry Fink, BlackRock built its dominance not by betting on markets but by modeling risk itself. Its core weapon is Aladdin, a risk management system that analyzes trillions of dollars across equities, bonds, derivatives, currencies, and sovereign debt in real time. Aladdin doesn't predict markets, it maps fragility. By the 2008 financial crisis, BlackRock was already advising the US government. By 2020, it was effectively managing parts of the Federal Reserve's emergency programs. This matters because BlackRock doesn't make emotional decisions. It moves when systemic math changes. So when BlackRock reallocates trillions, it's not reacting. It's positioning ahead of consequences. How America became the capital sink of the world after World War II. The United States didn't just win militarily, it won financially. The Bretton Woods system locked the dollar to gold. Oil was priced in dollars. Global trade cleared through U.S. banks. America became the world's balance sheet. Foreign nations exported goods. America exported debt, and everyone accepted it because the system worked until it didn't. In 1971, the gold backing ended. The dollar became a promise backed by trust, military power, and financial dominance. For decades, the trade-off was clear. America runs deficits. The world recycles dollars back into U.S. assets. Treasuries, stocks, real estate. This made its markets deep, liquid, and seemingly unstoppable. BlackRock built its empire inside this system. But systems don't collapse suddenly. They overextend first. From the 1980s onward, America made a subtle shift. Productive growth slowed. Debt growth exploded. Instead of building factories, capital flowed into asset inflation, financial engineering, share buybacks. Leverage layered on leverage, the U.S. economy became asset dependent. Stock prices mattered more than wages. Housing prices mattered more than affordability. Debt expansion replaced productivity. For asset managers like BlackRock, this was profitable, till the math started breaking. The breaking point when safety became the risk, three forces converged. 1. Debt saturation. U.S. federal debt crossed $34 trillion. Interest payments alone now rival military spending. This changes everything. When debt grows faster than GDP, the system requires lower rates forever or inflation. Currency depreciation, none are safe. 2. Weaponization of the dollar. Sanctions froze sovereign reserves. Assets once considered untouchable suddenly weren't. This sent a signal to global capital. U.S. financial infrastructure is powerful but conditional. That alone forces diversification. 3. Structural inflation. Post-2020 stimulus didn't just boost demand, it retrained markets to expect intervention. Rates rose, liquidity tightened, bond volatility spiked. Treasuries, the so-called risk-free asset, became unstable. For the first time in decades, U.S. assets became correlated with systemic risk. That is poison for long-term capital allocators. The move, $2.1 trillion out of America, actually means this was not a headline sale. BlackRock didn't dump U.S. stocks overnight. Instead, it increased exposure to non-U.S. infrastructure, shifted toward emerging market debt with higher real yields, Expanded private credit outside U.S. regulatory risk, reduced overweight U.S. equity allocations, rebalanced away from long-duration treasuries. This is slow capital rotation, not panic. The kind you only see before a structural shift becomes obvious. Think of it like tectonic plates, not earthquakes. Why this affects everyone when trillions reposition, consequences cascade. For markets, U.S. assets lose their automatic premium. Volatility increases, liquidity thins during stress events. For the dollar, not collapse, erosion, less dominance, more competition, more bilateral trade settlement. For Americans, higher borrowing costs, lower asset tailwinds, system less willing to bail out everything. This is not the end of America. It is the end of American exceptional immunity. Why policy can reverse this? Governments have three tools: print, borrow, regulate. All three now worsen long-term confidence. Rate cuts fuel inflation risk. Hikes break debt sustainability. Regulation drives capital offshore. There is no painless reset, only managed decline or unmanaged crisis. BlackRock understands this. That's why it moves early. History doesn't repeat, it rhymes. This pattern is not new. Britain, before World War II, the Netherlands, after its golden age, Rome, after currency, debasement. Reserve status fades, not from collapse, but from overuse. Every empire believes its system is permanent, until capital quietly disagrees. 3 takeaways. 1. Capital leaves before headlines do. By the time the public debates it, positioning is done. 2. Safety is relative, not absolute. What was safe for 50 years can become fragile in 5. 3. The system is shifting, not ending. This is rotation, not ruin. But rotation still creates winners and losers. When institutions stop treating a system as sacred, the system changes whether people are ready or not. BlackRock isn't predicting disaster, it's preparing for a different future. And the most dangerous thing you can do in a transition like this is assume nothing has changed. If you want more deep dive breakdowns on money history, global debt, and the hidden mechanics shaping the future of wealth, subscribe, because the biggest financial shifts never announce themselves. They move quietly until it's too late to ignore them.